Hit it.
It's Friday, May 13th. Wait, it's May 13th?
Yeah.
No, just kidding.
Let's try it again. Hit it.
What is going on?
I don't know, but you should leave all this in, Lena. Hit it.
It's Friday, May 13th, 2022, episode 179. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have the great privilege of one of our favorite guests returning. Jim Leitner joins us to discuss the dilemma facing the Federal Reserve, what he's trading to express that view, and what that means for other risk markets. Then, in this environment of whipsaw markets, it's never been more important to grab your box of Crayolas and hear what the Oracle of Ogre Orange Crayons has to say.
This week, we are doing a shortened segment, so you have to wait till next week for our segments of No Stupid Questions and Skin in the Game. And I usually say, well, folks, this is where we'll drink some beers along the way, but we're recording early in the morning and we have to trade. And Kev, we're not...
Yeah, Patrick, you got me up at 6 in the morning to do this one, folks. So it'll be interesting to see how we do. But let's get
anyway,
at it.
We have a great show. Lena, hop on, yeah. Well, normally you would tell us what beer we're drinking, but instead we have an announcement, right?
That's right. So we're having the Market Huddle piss up finally in Toronto at the Bottom Line, which is near the Hockey Hall of Fame. It's 22 Front Street West. It'll be happening Wednesday, June 1st at 4:30 p.m.
4:15, actually. Lena, 4:15. Yep, I'll be there at the 4 o'clock. The markets will close, and I'll head over there at 4:15.
And how many pitchers are we settling here?
You're the one. I think you said we were up to
about
50.
Yeah, we're going to do the official counting, and we're going to make sure we get it right because, as we say, there will be no ending of positions, and we will have to drink all 50 or whatever the number ends up being. And I expect Patrick might lose some still between now and then. So
the listeners need to come and help us out. Otherwise, I don't know if my liver can handle 50 pitchers. It's we're going to need our listeners to step up to bat and help us out.
So we have a section in between that's outside for the Market Huddle listeners. It's going to be a really good time. Come on by. Everyone is welcome. There's no cost to it except that be willing to, as Patrick says, to drink some beers with us. June 1st. At the Bottom Line, which is 22 Front Street, right beside the Hockey Hall of Fame. I know we've already talked to some of our listeners, and I have people coming in from out of town to come help us drink some beer, so it's going to be a good time. I'm looking forward to it.
All right. Well, let's get to our interview with Jim.
All right. It's our great pleasure to welcome back to the show for, I think it's the third time, Jim Leitner. Jim, thank you for taking time for us.
I think it's the fourth time. I'm so
the fourth time
here.
It's so much fun. I forget how often you've been here. And just for those who don't know, might not be aware, we're actually taping this on Wednesday. So this is Wednesday afternoon after the big sell-off in the stock market. And some of our information might not be up to date. We'll be publishing it on the weekend. So just be aware and keep that in the back of your mind when you're thinking about what Jim's saying. But let's hop into it, Jim. One of the things I'd just like to start off with is when I first met you, it was when I thought about writing it, and I called it my Jim Leitner moment. And the Jim Leitner moment that I thought about was when you described how way back before anyone had ever thought about negative interest rates, you went and you bought an option that it was struck at zero. And everyone thought you were insane. You went and bought this option that was struck at zero, and people thought there's no way that you can go negative interest rates. We obviously know now that we can. And I thought this was so smart. And one of the things that was kind of just shocking to me was how you were willing to think differently, and you were thinking about risks that other people were avoiding. And I'm kind of contrasting that to the current environment. And I'm thinking about what would be the Jim Leitner moment in this environment of, instead of low interest rates, high interest rates?
So I think it's actually a really good question because I think we've become anchored to low rates. The Fed funds rate, I think going back about 13 years, has averaged 61 basis points. And many people who've been in the markets for the last 15 years really don't know about higher rates. So I think that there is a large risk that rates end up much higher than we expect. So thinking about inflation, and obviously what is driving interest rates here is the Fed's response to inflation. right? The Fed has now decided that inflation is a real problem. And it seems to me that the Fed has not really thought through what the correct response is, or they have not been able to communicate it very clearly if they have thought it through. So when you think about inflation, part of it is monetary, but part of it is also fiscal, right? And
Yep.
the Fed does not have any impact or influence on what's happening in our fiscal system. So the part that is driven by fiscal inputs really is not going to get affected by what the Fed does. And the other thing is that the Fed can basically concentrate on the demand side that's driving inflation, but not really on the supply side. So we've had quite a bit of supply side inflation in the last year, and clearly even more so since the Ukrainian conflict started. And, the Fed feels very certain that they know how to crush inflation if they have to. There was a paper written in 1981 that was by two economists called Sargent and Wallace, called Some
Okay.
Unpleasant Monetarist Arithmetic. And, one of the Fed economists at the Fed of St. Louis just 2-3 months ago published kind of a rejoinder to that really points out how important fiscal policy is to managing inflation. That the Fed can change interest rates, but fiscal policy needs to be directed towards keeping the debt to GDP ratio relatively unchanged so that the Fed's policy can feed through into the system in a coherent way. And if the fiscal policy is not set to such a stable debt to GDP ratio, then it's not clear that the Fed has all that much influence over long-term inflation. So, I've looked back at inflation. I started trading in 1977. So I was
You're
there.
dating yourself, Jim.
I was there at JP Morgan when Volcker took rates to 20%. And, I'm looking at the rates today and I'm thinking, the futures market is now forecasting that the Fed funds rate will peak out someplace around 3.2%. The Fed has basically said that neutral is around 2.5%. They feel that, that'd be 70 basis points contractionary, tight. But maybe, that will not be enough. So what did Volcker do to really bring inflation down, right? He took rates to 20%. Well, an economist named Taylor in the 1990s developed the Taylor rule that basically looked at, if you were going to run monetary policy based on a rule, how should you be setting interest rates? And if you look at the Taylor rule on Bloomberg, just type TAYL, and you'll see that, if you set the real rate, the real neutral rate at 0, then it calls for a Fed funds rate now of about 8%.
Right.
And that is when you use...
Sorry, I didn't mean to interrupt, but one of the interesting things about that rule for those that are interested, although it is a rule and although the Federal Reserve never expressly stated that they were following the rule, you'll see that it actually does track what the Fed did over the past few decades rather closely.
Yeah, exactly. I think actually the Taylor rule, was developed with the idea that, over long periods of time, a monetary rule would help the Fed in containing inflation and bringing it back to the 2% level. Now, when Taylor did it, he thought that you should always set the real rate, the neutral real rate at 2%. I think
Right.
that was too high. I think the neutral real rate is probably closer to zero. And I've always thought
Okay.
so. I've thought that even in the 1990s. And I really reasoned from the view that in the front end, people ought to not be able to make risk-free returns without taking risk. Like you should make a return if you're willing to extend your duration. So you buy a bond, you're taking maturity risk, or you buy an equity, you're taking equity risk premium. But if you're just keeping your money in the bank, you should basically get your money back. So if the inflation target is 2%, and if you're earning 2.5%, and you're paying some taxes on that interest income, then I've always felt the neutral rate would be 2% nominal, 0% real. And if you set the
Okay.
Taylor rule like that on the Bloomberg terminal, and if you look, they have different kinds of inflation. You can put CPI inflation, you can put the one that the Fed follows, core PCE. When you use core PCE, right now it is calling for a Fed funds rate of something like 8.2%. And the market is clearly not building anything like that in. So why am I nervous about us actually going there? Well, number one, the Taylor rule, as you say, has over long periods of time kind of foreshadowed Fed policy. Number two,
Right. Yeah.
I think that the Fed believes that they have a tremendous amount of influence on inflation, but so many parts of inflation really come from areas that are not subject to the Fed. So, for example, we've seen that commodity prices have gone up dramatically in the last year and a half, and then they've certainly jumped since the Ukrainian conflict. Whatever the Fed does is not going to have any influence on agricultural prices. So when the Ukraine is the largest exporter in the world of sunflower seed oil, and it supplies the entire Middle East with this edible oil that's used for cooking, and Russia is in the top 5 exporters in the world for that same oil, you've got to say that whatever the Fed does, sunflower seed oil and other edible oils will probably be going up in price. And that's exactly what has happened since February. They've accelerated upwards. Or if you think about European dependence on Russian natural gas, whatever happens in Ukraine, in the next 2-3 years, Europe is going to try to reduce its dependence on Russian natural gas. I mean, it doesn't matter if the war stopped tomorrow, Germany is going to work on figuring out ways to be less dependent on Russian energy. So if that leads to dislocation in price, and we're seeing it in the front end of the natural gas curve, we're seeing it in oil markets, we're seeing it in agricultural markets, whatever the Fed does is not going to have any real impact on inflation from that perspective. The other thing,
But wouldn't that imply, therefore, that the Fed shouldn't go and raise rates if they can't affect it?
well, yes, but they seem to think that they can affect it just from the demand side. They seem to think that if we slow down demand enough, then we will slow down inflation. And that's
Right.
probably true. If you actually get people to lose their jobs and not
Right.
drive anymore because they don't make any money, so they can't actually afford to buy gas, or they just don't go out to the restaurants anymore because they lost their jobs, then yes, you will have an impact on inflation. And the Fed is clearly looking at labor costs. If you look at the Atlanta Fed wage inflation tracker, a wage growth tracker, that's running at 6%. So that's making the Fed nervous. But when you think about it, 6% wage growth is still negative 2% versus CPI.
Right.
So, workers are not feeling like they're getting any big raises when they're seeing that their real wages are actually, even after inflationary increases, depreciating.
So you think there's a greater chance than the market does that we are going to have higher interest rates to be able to eventually to tamp down this inflation that we're experiencing? How soon do you foresee this, and how would you play that?
But I think that it'll take time. Like the Fed is still thinking that over the next 6 months, inflation is going to start coming off. We're going to have base effects. We were supposed to have base effects today, right?
Right,
And
which we didn't.
and we really didn't. And I think we're going to have more and more evidence over the next 6 months that inflation is much more built into the system than we expected. So, for example, if you look at the wedge between PPI and CPI, it's at
Yeah.
it's at 3 to 4 standard deviations from the mean. So when you look back to 1950 and you take CPI minus PPI, we're now at 6.6% difference, which has to go someplace. I mean, corporations either have to cut their margins
Right.
or they increase their prices by enough so that the margins stay stable, and then the PPI inflation flows through into CPI inflation. So that leads me to another thing where I think the Fed has really very little control, and that's corporate political power. In the last 20, 30 years, corporations have become much more powerful in the US. The competitive landscape has changed dramatically. We now have many fewer corporations competing. So, like in the 1950s, there were about 50 defense contractors. Now there are 4 or 5.
Really? I had no idea there was 50 in the 50s.
Yeah. If you look at things like chicken processing plants, they're very, very few. And the other thing is they don't compete with each other. Like, if there is Tyson in one county, nobody else goes in there to compete with them. They just keep their county. So, competition has really dramatically, oops, sorry about that.
That's all
Competition
right.
has
That adds some color to the show. That's all, Jim. No problem.
So I think with competition having dramatically changed, we also see that in the data on corporate margins. So profit margins are at historic highs on the S&P. And in the last quarterly earnings, we've seen corporations do quite well. And they're blaming the raising of their prices on inflation, but their profit margins aren't doing all that badly. Their
Right.
profit margins are still at like 14.5%, which are fairly wide. And if you look at profits as a percent of GDP, again, that's also at historic highs. So when corporations have this much political power, it's really hard to bring inflation down. Like, how do you make corporations not pass through the PPI inflation to the consumer? Again, that comes back to the fiscal side. You need the executive, the FTC, Lena Khan, who works there now, to say, we are going to make the U.S. economy more competitive.
And isn't that a longer term problem as well? Like, or solution? Like, that's not going to change anything over the next year or two.
Exactly. No, but that's exactly why I think that, inflation is built in and it's not going away very easily. And, I think that we will be looking back 6 months from now and inflation, maybe it comes off. So it's not at 8.5% or 8.3%, but, it's come down to 6.5%. And the Fed's going to say, we're still way too far away from our target. So I was super surprised when Jay Powell took the 75 basis point possible increase off the table.
So what do you think he was thinking when he did that?
I think that we had an equity market that came off quite a bit, like, depending whether you look at NASDAQ, over 20%, or the S&P, whether it was that day, 16%, and he was thinking that maybe if I'm just calm, I can get the market to slowly rebalance rather than quickly rebalance. And
Unfortunately, when he took it off, it rebalanced the other way pretty hard because everyone had assumed that 75 was on the table. What did we rally 4% that day or some crazy number?
yeah, it was, like down 4% the day before and then up 4% the next day and then back down 4% the next day. So
do you think that there was if you remember when he first came in 2018, he was fairly hawkish and he was I distinctly remember him talking about the cost of cleaning up a bubble is greater than stopping a bubble in the first place, and he was very much hawkish. He took the 2-year real tips yield, the real yield for the 2-year from I can't remember 0 up to 1.5, almost 2, and eventually the stock market freaked out and he was forced to pivot. Do you think that there maybe was elements of that reminder in the back of his mind?
yeah, definitely. I mean, he's been there. He saw 2018. He saw how quickly the market can really get unraveled. And, I don't think that there is a Fed put right now, but there's a desire by the Fed to thread the needle, to get to some kind of soft landing. And if the stock market were to be down 30% more, I don't think you'd be seeing a soft landing. You'd be seeing a pretty hard landing. And I think
right. And do you think though? Let's go down that road actually, just kind of quickly. Let's imagine, we're taping this, and the stock market has had a terrible day, and it looks like the 12,000 didn't hold in the Nasdaq. Let's imagine that it accelerated from here, and that we did have an environment of we were down 15-20% in a week. Do you think you said that there's no Fed put?
Yeah.
Isn't there a point where at some point they're going to get nervous about that, or no? With inflation here, there really is no put.
No, I mean, there is clearly a put someplace, but I think it's significantly lower. So, if we dropped 15-20%, he's going to say, look, this is all getting a little bit out of hand. And yes, we're raising rates, but, I took the 75 off the table. And, we're going to, as he says, we're going to be nimble. Again, something that makes me very nervous because I don't think central banks ought to be nimble. I thought, they should have a policy framework, and within that framework, try to address the problems that, they're trying to address, which right now is inflation. I think also that, back to like the early 2000s, 2002, last 20 years, the unemployment rate average has been 6.1, and now we're at 3.6. How badly would he feel if we go from 3.6 to 4.6? I don't think he can feel all that terrible. People are anchored to these really low numbers in terms of interest rates, in terms of unemployment, and they're anchored to high numbers on where the stock market is. The Fed in the last press conference, Powell started talking about the FCI, the Financial Conditions Index.
Right.
And, when you look at the Financial Conditions Index, if you look at the Goldman one, it's actually not even restrictive yet. It's still below 100. It's at like 99.2 or something like that. If you look at their website, every 1% drop in the stock market is worth 5 basis points on the FCI. So just to get the FCI back to 100 from here, if you left all the rates exactly where they are, you could drop the stock market by another 18%. Just to get it
to par, just to get to the Goldman Sachs to par, and that's not even that
and that's not restrictive. That's neutral, according to the Goldman research. Now, maybe the Goldman one's not the best one. There's a Bloomberg one, which is already on the restrictive side. But, how restrictive is it really?
I think that the Bloomberg one is more the rate of change as opposed to absolute levels. So therefore, if it goes fast, it seems to tighten really quickly. And I think that's the problem there. But no doubt that he wants the financial conditions to tighten. He actually said so in this, in that press conference. He argued that the way that monetary policy is transmitted to the real economy is through the financial tightening of financial conditions. So does that mean that the stock market's probably in for a lot more pain before he even thinks about changing his tone?
I think so. Yeah. I think this is one of those years where, if you had randomly selected a year in the last 30 years to look at where the stock market would be a year later, 80% of the time it was up. But 20%
Right.
of the time it was down. It seems to me like this is one of those 20% years that, you normally don't bet on 20/80 probabilities, but, everything is lining up in terms of the Fed, in terms of COVID, in terms of Ukraine war, in terms of underinvestment in commodities for the last 15 to 20 years, that, it's maybe time to see one of those 20% occurrences. So, I've absolutely sold all my equities. I just have a very hard time actually being short. It's not that it doesn't make me money when I trade from the short side, but, like we all have blind spots.
Yep.
And having traded for, several decades,
Yep.
lots of decades, it's kind of like built into my psyche to earn risk premium.
Right.
And it's
Okay.
really hard for me to be short risky assets unless they are stupidly overvalued. But just
So your
before,
neutral is
before,
almost short in that you don't have any exposure. You're generally like to be long, so the fact that you don't have any longs is about as bearish as you get on equities.
yes, I think that's a
Okay.
true statement. So I have
Yeah.
a couple of equity long call options, but very little. I have no cash exposure whatsoever.
Okay, and so let's go back to the rate bet, because I'm very curious. You expressed the belief that there's more of a chance that the Fed will have to raise rates higher than the market expects.
Mhm.
How do you structure a trade to take advantage of that?
Oh, so I think this is actually really easy. I mean, that I like what they call digital options because it gives me the possibility to really think about what are the odds on a certain bet.
Right. Why
So
don't you, for those, I'm hopeful everyone will have tuned in and heard all your other great four interviews, but just in case they didn't, why don't you explain to people again what a digital option is, just kind of as a reminder?
sure, a digital option pays out 100%. And for that, you pay something upfront. So let's say you paid 15% for it upfront. That means the most you can lose is 15%, and the most you can make is 100%. And basically, the market is telling you that it mathematically comes up with a probability that this event will happen with a 15% chance.
Right.
So, if you're right,
So
you
for
end up making about 6x on your money, 6.6x, because you paid 15 and you'll get paid 100 at the end. And one way to do the actual implementation is just to do very tight call spreads or put spreads around the event that you believe is going to happen. So
right, okay,
if we say, okay, the Taylor rule says that the Fed funds rate could be as high as 8.2 right now. The market is saying we're at 3.2. That's the kind of peak for, I think it's June next year.
right,
Um,
okay. So you're trading the euro dollar futures curve, and you're looking out to June of next year, and you're saying that the market is implying that we're going to have a 3.2%
Interest rate.
3-year LIBOR rate at the time.
Correct. And, if I think that, okay, maybe Taylor is a bit too aggressive, the Fed is also anchored to these lower rates, it takes them a while to change their mind. So what if I meet in the middle between 8.2 and 3.2? That's like 2.5 up. So that gets me to about 5.75%.
Okay.
So I I actually said to myself, well, what if I set that rate at 5.25%? So I'm not even going as far as halfway towards Taylor.
Okay.
And in terms of Eurodollar futures, that would imply a price of 94.75, right? Because Eurodollar futures are priced as 100 minus the interest rate.
Right.
So
Okay.
5.25 becomes 100 minus 5.25 is 94.75. So I did the 94.75, 94.50 put spread,
Okay.
which
So you
means,
bought the 94.75s and you sold the 94.50s.
right. And if we end up at 5.5%, I did
Yep.
this for December of 2023. So 6 months after the current peak. By then, I figure people will have really thought about that maybe this inflation is not transitory. Maybe we're going much higher. Maybe we're getting to 5%. You know, I paid for that 25 basis point wide spread, 3 basis points.
Right. Okay. So you
So,
paid 3 and you can make another 22 if you're correct.
correct. So you can make basically 7 times your money,
Okay.
right?
And that's how you're doing it. And um, now I'm just trying to do the math real quickly. You probably have done it already. What percentage is that actually? What is the market saying the probability of you winning that is?
Well, the market is saying that it's about 15%, right?
Right.
3 divided by 25,
Yeah.
whatever that is.
and so now the thing about this trade is that it's assuming that this is a large move. And one of the things that kind of shocks me about this is that we've already seen increases in volatility in the whole euro dollar space, but in terms of that, because it's a digital, it's not as affected by that as much.
That's correct. It
Right.
is affected, but less. With very high volatility, you clearly have more probability that you get outliers. So it is more expensive than when volatility is lower, but it's clearly not affected as much because you're also truncating your upside. You're saying, I'm only going to make 25 basis points, even if we go to 8%.
Right.
It doesn't.
You're giving that up,
away
and you're
the
saying that
upside in this
this
rate.
is the all I'm going to make.
Exactly. But because of that, all I have to pay is 3 basis points to make 25. And I think, 7x return is totally
It's
acceptable for an idea that, in my mind is not only 15% probability.
right. It's
Um,
in your mind, it's much higher.
yeah, in
Like
my mind, I think, on the path 6 months from now, if inflation is still way higher than what the Fed would like it to see, they will be talking about 75s. And people like Bullard will be pushing for much higher rates. And Bullard is already talking about 3.5% a year from now, not 3.2%. And I feel that a lot of the problems that we're seeing that the Fed can't address, like COVID in China, it's just, like a random event. And randomly, it could get much worse. And, when you start seeing shipping delays of the length that we have had, like 7, 8 days longer than average times, that has a hugely inflationary impact.
right.
There was a paper written a couple of years ago, like about 7, 8 years ago, that was called Time as a Trade Barrier. And the IMF just updated that. And it basically comes out to every extra day that shipping takes to bring goods from one country to another is equivalent to increasing global tariffs because the extra money it takes to hold the inventory, the extra working capital, the extra insurance you're paying, all that stuff. It's as if it were a tariff. And the IMF paper basically posits that the delays that we're seeing right now in the market are equivalent to all the tariff reductions we've had since 2003. So it's as if those had never happened. They're all gone.
Wow.
That's a lot of tariff reductions across the world. And,
Right.
I think we're starting to see these kind of things show up in inflation rates every place. You and I have just talked about today's US inflation rate, but, China last night reported higher inflation than was expected. Czech Republic was reporting higher inflation than was expected. Hungary is reporting higher inflation. It's happening all around the world. And I think, we are all so interconnected that, this persistence of inflation, I think, is going to become a theme, a trope, a meme that is just not going to go away. And when people start jumping on that idea, then markets will readjust.
Right.
Like you had asked
Do
me
you
a
do you think
question.
do you foresee? Sorry, I didn't mean to interrupt, but do you foresee a Wile E. Coyote moment? Because as you
Yes.
mentioned, the
Yeah.
Fed and the market, they still kind of in their hearts of hearts think that inflation is going back down. And yeah, maybe we're not going back down to 2, but they think that we'll be back down at 3 or 4 in no time. Don't you think?
Yes, that's what they do think. I mean, that's what they're saying, that we'll get to
Right.
4 and then we'll be at 3. And then by the next year, whether it's 2024 or, whether it's the beginning or the end of 2024, we'll be back within the target range with a 2 point something or other. And
Now, do you think that Wile E. Coyote moment causes mayhem in other markets? So yes, I understand what you're saying about your interest rate trade, but how does that kind of morph and spread throughout the rest of the financial system?
Well, I think, when things happen rapidly, markets break. And, we saw that in the last 3-4 months, when things suddenly started unraveling, markets started breaking. I mean, one of the questions you asked me is, what did I learn during COVID?
Right.
And one of the things I learned was something that I hadn't thought enough about. And there's a little puzzle. I like puzzles. I don't know if
Yep.
you want to go through this puzzle with me, but
Yeah, let's do it. Let's do it. So for those who don't know, I sent Jim some questions beforehand. I said one of the things that I was thinking about is, Jim's a very accomplished investor, but he's a student in the market. He's always learning. And the question I asked him and posed was, what did you learn today or after the last couple of years that you wouldn't have known before COVID had occurred? And so what have you learned over the past 2 years was in essence the question.
right. And I think the easiest way to talk about it is to solve this simple little puzzle that you will easily solve. I mean,
I hope so.
It's almost like going back to the 3 doors and the Monty Hall paradox.
Okay.
But we will do something similar. So imagine this island with 100 blue-eyed people and 100 brown-eyed people.
Okay.
And nobody ever discusses their eye color. It's just taboo. Nobody knows their own eye color. They can look around and see somebody else's, but it's just not done to talk about it. And
Okay.
every night at 12 o'clock, a ship comes and, will be willing to take you away from the island if you can tell the captain the color of your own eyes. Now, nobody has ever left the island, but one day this wizard arrives on the ship and looks around and says, I see somebody with blue eyes. What happens next?
I don't know.
You don't know.
Tell me.
I will tell you. So let's just imagine that there are only 2 people on the island, right? One's blue-eyed, one's brown-eyed. The blue-eyed person looks over and goes, "Oh, okay, he has brown eyes. I must have blue eyes." If the oracle or wizard has just told me that there's somebody with blue eyes, so the next night when the ship arrives, he goes to the captain, says, "I have blue eyes." He gets taken away, and the next night the brown-eyed guys leave because he says, "Well, obviously I didn't have blue eyes, so I must have brown eyes." Now, if you do this with, say, there are 3 people and there are 2 people with blue eyes and 1 with brown eyes, they look around and they say, "Well, there's this other guy with blue eyes. Now, he should be going to the captain tomorrow or tonight when the ship arrives." And the other guy looks at the other 2 and says, "Oh, there's a guy with blue eyes. He should be going to the captain." Neither of them goes to the captain the first night because they don't know that they have blue eyes. They think
Right.
that
Okay.
the oracle was talking about the other guy. But
Okay. I'm with you.
when they see that nobody leaves, they say, "Well, that's kind of strange. If that guy is not leaving, he's not leaving because he's seeing another blue-eyed person. That must be me." So after 2 nights, both of them go down to the captain and say, "We're out of here. We have blue eyes." And then on the 3rd
Right.
night, the brown-eyed guy leaves. So what happens when you have 100 people? At the 100th night, all the blue-eyed people leave and get on the boat because they're all very rational and they can figure this out. And then the next night, all the brown-eyed people leave. And
Okay.
now the question is, why? How does this happen, and why does this happen? Because everybody knew that there were blue-eyed people on the island; they could see that, but it wasn't common knowledge until the oracle told us that somebody had blue eyes, and then everybody knew what everybody else knew. So
Right.
once
Okay.
there's common knowledge, you can get cascades. Once there's common knowledge, you can logically figure out, oh, if everybody else is doing this, then I need to do this. And I think, markets see these downward cascades when something becomes common knowledge. So when COVID started, for example, the markets really didn't react for the first, I would say, week or so, until it became common knowledge that this could be a really big problem. And then everybody wanted out. I mean, if you look at the charts, how quickly after, we heard about COVID in January, and it took till like end of February until the markets really got hit hard. And I think with inflation, something similar happened. Everybody realized that inflation was a problem because inflation in March of 2021, the CPI went to about 2.6. And then the month later, it ended up going to like 3 or 4. And, by about a couple of months after that, we ended up being, we ended up being up at like 6% by September, October. But it wasn't until Powell started speaking about inflation that it became common knowledge. Everybody looked around and goes like, oh, there's a bunch of inflation going on. I wonder what it means. Should I be getting out? Should I be selling bonds? And then you don't see anybody else selling bonds. So you kind of go like, well, maybe I'm misunderstanding this. But when it becomes common knowledge that something is happening, then suddenly it starts happening. And I think, Powell made it common knowledge that inflation was an issue. And he started that in November in his first couple of speeches. And then in December in his press conference, it was very clear inflation is a problem. And
couldn't you also, sorry to interrupt, but couldn't you also argue that the Powell is going to tighten financial conditions is the same scenario?
Yes, exactly. And that kind of gets me back to listening to the game master. You have to listen to the game master to know what is common knowledge and what isn't common knowledge. And that's when you might want to change your positions. Like he's opening a certain door. He's saying, we didn't really think about the FCI before, but now we really are thinking about the FCI. Read my lips. I'm telling you, we think that the FCI needs to tighten. How is that going to happen? Well, there are 5 ways to do it. We control short interest rates. I guess that's what they're going to do until other things adjust. I mean, if the Fed just raised rates a little tiny bit, let's say they only raised them 50 basis points, but the stock market dropped 30%, well, then the FCI would be tight, right? Because the stock market, one of the 5 factors that drives the Goldman FCI is the stock market. Well, if any one of those factors moved enough, then the Fed would be able to do less. However, if the other factors don't move by enough, then the Fed will just have to keep raising rates.
Now, that's an interesting question, and it raises the idea that you could make the case that the actual economy is fairly strong and able to withstand higher rates. And one of the things that you have to kind of think about when you're examining the Fed's policy is, will raising rates be enough to tighten financial conditions? And when will that affect the actual underlying economy? And is it just affecting the stock market? If you understand what I'm saying, like if we had a situation where they went and the stock market declined, and yet it didn't bleed through to the real economy, it would be they'd be in a real tight spot, don't you think, in terms of their inability to slow down the real economy because they're assuming that the stock market's going to do it.
Yes. However, I do believe if you get enough of a stock market decline, you will start seeing the effect in housing, in the wealth effect. People
So
own.
you're a believer that is how monetary policy is transmitted, is through the financial conditions.
I think that it explains a lot. I
Okay.
mean,
So
whether it's
you don't worry that the
way,
Fed goes and crashes the stock market, and yet the economy stays fairly robust.
no, I think that if the FCI goes into restrictive territory because the stock market comes down another 20%, then we will also start seeing the economy slow down. Housing is clearly going to start weakening at that point. I mean, already I think housing demand is starting to weaken with mortgage rates at 5.5%. It's not the same as when they were at 2.5%. What was that? A year and a half ago? I mean, it's
But then,
already
Jim,
starting to
your bet that rates are going to be what, I can't remember what the number is, 5.5 by the end of next year. Isn't implicit in that bet the assumption that the stock market doesn't crash?
No, I mean, if the stock market crashed by enough, then, I think the economy would slow down. But like I said earlier, there are all these influences that the Fed has no control over. Like this economy could slow down, but inflation could just continue at high levels. If corporate power is such that they can keep raising prices and passing through other inflation, inflation that's coming from raw materials, then the Fed is going to be between a rock and a hard place, and they will have to crush the economy even more if they really want to bring inflation down. I mean, if their target is bringing inflation down, not slowing the economy is a step towards bringing inflation down. And I
Okay.
think the ability to bring inflation down is just much less well defined than they think. Like, they have influence over one or two things, right? They have influence over short interest rates and then the size of the balance sheet. So if you look at those two things, okay, you can slow the economy down. But what do you do if inflation continues high? Then do you slow it down even more? I mean, at what point, like if you let inflation go back to 6 because the economy is slowing down, do you then say, "Oh, we won the war," or do you say, "Ooh, this is not good.
Right.
We might have to actually drive the economy even slower. We need to get, the unemployment rate from, let's say, wherever it ends up being 4 back to 5 or to 6." And I think that,
Now,
these are very difficult questions for the Fed because I think they're not really operating with a systematic approach. They're just thinking they can raise rates and everything is going to work out. We're going to be nimble. And as Yellen said about 2 weeks ago, we'll need a little luck to have a soft landing. That makes me feel very uncomfortable.
right.
I don't
Now,
really believe in luck when I'm talking about the Secretary of the Treasury in the Federal Reserve.
one of the things you just mentioned is the Fed's balance sheet, and this is a lever that they can pull. I was surprised that they have put it on autopilot and not used it as a policy tool. And they seem to have wavered back and forth. At times, they've talked about using it a little bit more as a policy tool, but it looks like the people that just want to put it on autopilot have won the day. Were you surprised? And do you think that's a mistake? Do you think they should be using it as a policy tool?
Yes. I mean, I think that they should have stopped expanding the balance sheet, like 7, 8 months earlier. When we started seeing the reverse repo facility build up,
Yeah.
which meant that there was excess capital, excess cash in the system, it didn't make any sense to me that they continued to expand the balance sheet.
Right. And yet they did.
So that happened, when was it? Last July or so, when you started seeing that spike up in the reverse repo facility. And I think that was an indication that you've expanded the balance sheet enough. Just stop. But I think it was a big mistake to not stop then. Of course, in economics, you can't run thought experiments and say what would have happened if they had. But maybe we wouldn't be facing some of the inflationary pressures that we face today.
But why don't they so we all know inflation's a problem. We all agree that, or at least the Fed believes that the balance sheet reduction will slow the economy. So why not increase the pace upon which you wind down the balance sheet? Why not change it based upon?
I think they're a little bit nervous about understanding what it can do. I think on the way up in the stock market and the expansion of the balance sheet, a lot of people were running regressions one against the other and saying, oh, if as the balance sheet expands, the stock market's going up, and these two are highly correlated. I'm not exactly sure how it works, but clearly one must be driving the balance sheet must have some kind of influence on driving the stock market higher. And I think that, they are nervous because they don't really understand whether it's a stock issue, a flow issue.
So they're taking like the doctor's oath. They said, do no harm and go slow and just put it on autopilot and try not to make a mess.
Right. It's kind of a little bit what they're doing with the front end rates, like go slow, like take the 75 off the table.
So here, I'll put you on the spot, Jim. Do you think that they get down to the balance sheet, the pre-COVID balance sheet level?
No, I don't think so. I think that we will hit really rough times a year from now, and at that point they'll stop reducing the balance sheet, I think. But we'll see. I mean, I also don't know how high rates will go, right? So I think between those two things, the economy is in for a rough ride over the next 18 months.
So shifting the conversation a little, last time you were on the show, you gave just one heck of a call, Jim, and you talked about that you were buying euro, the currency volatility. And
that was a good trade. Yeah, that worked.
It was a good trade. Why don't you tell people what why you did it? You obviously, it helped along by a rather unfortunate war in Ukraine, but it ended up being a great trade. And why don't you tell people what your thinking is right now in terms of currencies and whether you see any other opportunities in that square?
Ooh, hard question. I mean, to me, currency volatility had just not adjusted. When we started seeing volatility increasing in interest rates, increasing in equity markets, it just seemed to me that there was a real lag the way currency volatility was still trading at historical lows. And, I thought that the probability of them going higher rather than lower was just skewed. And I got lucky. And, as the Fed started talking more about inflation and what they had to do, then currency volatility started jacking up and it worked out okay. I mean, right now, I have a feeling that the dollar has become rather strong because the Fed has been quite aggressive about talking up the interest rates. And, in terms of valuation, the dollar is at very high levels. And I've started buying currencies that have high commodity exports from countries with high commodity exports and improving terms of trade and positive carry. So to me, the fact that Brazil is an exporter of soybeans and oil is a positive. To me, the fact that there's an October election in Brazil is a positive. The fact that the central bank in Brazil understands inflation. I mean, they have had inflation over their history, plenty, much more than our Fed.
Right.
And they started raising rates from 2% in March of 2021 to something like 11.75% now.
Right, and the real yield is through the roof. It's like one of the few real, positive real yields that you can get out there.
Yeah. So to me, given that I believe that commodities are in a positive cycle because there's been underinvestment, because this war in Ukraine is hurting agriculture production, because fertilizer prices have exploded, given that oil prices are going up and given that fertilizer raw materials are coming from Russia and therefore are not coming right now. I think countries like Brazil, who have improving terms of trade, are interesting places to be invested. And given that the forwards imply weakening Brazilian currency, right? If the interest rate is 12% and our interest rates are, say, 1%, you're earning, just under 1% a month in positive carry.
Right.
That, that's
It's a lot.
that's a nice
It's awesome.
number to wait, and
Yep.
it's also one of the few currencies in the world that's actually up on the year.
Yeah.
Against the dollar, even though the dollar has been going up against virtually everything else. So I think that we could see a stronger real by the end of the year. I think that Lula, who is running ahead in the polls against Bolsonaro, will probably win. There has always been this fear of populism, but the last time Lula was president, 2003, the Brazilian currency was at 3.6, and by the time he left office in 2011, it was at 1.9. So we had
which is an appreciation for those who don't know. It's the opposite, right?
Yeah, we had a huge appreciation of the Brazilian currency during his time in the office, and I think he's a populist who wants to make Brazil a better place. He cares about the poor, he cares about the safety net, and there's a central bank who clearly knows how to deal with inflation, having had plenty of practice and was not afraid to start raising rates way before the Fed. The first time that inflation in Brazil started going up, they just started raising rates. So it seems to me that, there are some currency opportunities.
And so, Jim, do you just buy that outright and earn the carry, or do you do
Well,
you execute
I
that
do
through
options.
options
You
as
know
well?
me. I mean, I do options. I do the same kind of digital options, which get super cheap, even though the volatility is high. But number one, because they're digital, so those very tight call spreads on the Brazilian currency or put spreads on the dollar are relatively inexpensive because they're priced off a forward price, which makes the Brazilian currency very cheap.
Right.
So I think that, I don't know where those prices are today, but you can get easily like the 6x, 7x kind of returns if we're going back to 4.5. The other thing is that in December of 2019, so just before COVID started, dollar Brazil was at 3.95. So say 4. And dollar Brazil today is at 5. So that's 20% weaker than when COVID started. And
the fundamentals have gotten better.
The fundamentals have gotten better. The commodity markets have gotten better. The carry has gotten better. COVID
it's a great,
probably going to be something that we all get accustomed to, and we'll just like getting a flu shot. We'll be getting an annual COVID shot.
I love it. It's one of my favorite trades, and I completely agree with you. In terms of your portfolio, I hope this isn't overstepping, but are all your investments just a series of options like that, or are there things that you own straight deltas on?
Yeah, the ones that have really hurt me. So I'm down on the year, not on my trading, not on my thinking about macro, but on trying to be a disciplined long-term investor in crypto.
Oh, okay.
I think I told you that I put 3% of my net worth into crypto in 2019. Right. And at one point in November of last year, it was 38% of my net worth.
Yeah,
and I said,
which Jim, hats off to you for riding a trend. Like the trend followers, those folks have nothing on you. You're every bit as just unbelievable at sticking with it. And I was just, when you told me that, I literally had to pick my jaw off the floor. I couldn't believe it.
Well, took off 8% at that point of my
Right.
NAV. So, I kind of locked in some good profits, but, now it's back down to being worth 5% of my NAV. So, I think it's probably not the smartest way to have invested, but if you really, I really do have a long-term view that it's like options premium. It can't go under zero. I have no leverage. I'll be unhappy if I lose the last 5%, it goes to zero. But I actually do think that there's something to the whole crypto world. I think that blockchain is an interesting idea that is, in a philosophical sense, bringing back community. In the economy, we have the market, which is really driven very much by individuals. However, the community itself is undervalued. There's a book by Rajan, who was the central bank governor of India. It's called The Third Pillar, and it's about the state and the individual and community. And he basically says that over time, the community has lost its importance in economic systems over the history of the last 500 years. And blockchain,
as it's gotten as we've gotten larger and as the markets have gotten bigger and people, the population is, you don't know anyone. It's these faceless transactions.
Right. And in the past, like 500 years ago, you were in a market, but yes, you knew everybody else. It was your village market. It was a community. You worked with each other. And I think on blockchain, you often actually are in the same boat. You're working with each other. You're trying very hard to make the project that you're working on successful. And you're working on it all together with a profit motive. But you realize that really it takes a village to raise this project.
Right. So, now, unfortunately, some people were bad apples and not taking care of the village lately with this Luna.
Yes.
Have you followed this story?
Yes. I mean, it's been a painful story. I mean, I don't own any Luna, but I can see that was a quite painful story for many. And, from what I read, it really revolved around market power. Somebody very large basically created the instability and made a lot of money off it.
Yes.
It's not like there was a fraud and somebody hacked the system and absconded with the money. Plenty of those things have happened also, like the Beanstalk hack that happened, say, 2-3 weeks ago. I think in this case, it was really just not market manipulation with the bad, the illegality of manipulation, but just market power. Somebody very large sold a very large amount and unhinged the stable coin. And once the stable coin, kind of ran out of enough people supporting it, it collapsed and it wasn't stable anymore. And then the underlying Luna currency got battered because everybody decided just to get out.
One of the things that I worry about with crypto, Jim, and maybe you could, I don't know if you'll be able to answer my question, but I worry that because it is an unregulated market and because you can create credit, that we've had a wild expansion of credit over the last couple of years that we don't truly understand. Now, a lot of the crypto enthusiasts will say, yeah, but the banks create credit, and they're absolutely correct. Banks do create credit. But the difference is that, back in the 1800s, when there was no regulation, there was, 20,000 banks or something like that. And they created all sorts of credit. And then when the 20s came along, then the 1920s, and there was the Great Depression, 15,000 of those banks went out of business. And it was part of the problem. It was this kind of expansion and then a contraction of private credit. And one of the things that I worry about is that with crypto, this is occurring and we don't know. And I think back to the great financial crisis, and, everyone now thinks that it was so obvious, but they forget that back then it wasn't. Yes, we all knew that there was some crazy things going on, but very few people truly understood the extent of the of the amount of leverage and the CDO squares and all the different aspects of it. And what I worry about is that there's a great financial crisis, a CDO squared moment sitting in crypto that is still yet to be uncovered. Do you worry about the same thing?
I don't worry about things in life. I don't like to worry about things I have no control about. But I do
You're much wiser and smarter than me, Jim.
I do think about it. I think I wouldn't use the word worry, but I do think about
Okay,
it.
so have you? What do you think the
you have a point.
probability is of my worry being correct?
Yes, I do think that you have a point. I think that the probability of you having identified that there is unknown leverage um, is more likely correct than not. I mean, we've seen like this thing with Luna. That's wasn't such a huge amount, really. I mean, we're not talking about like $500 billion worth of losses. But if you actually started seeing very, very large numbers like that falling apart, then I think it would be of systemic importance. And I think that at the government level right now, there's a lot of talk about regulation and treating a lot of these stable coins kind of like banks, and making sure that they have adequate reserves and understanding who their customers are. And I think that over the next 12 months, we're going to start seeing quite a bit more regulation in this whole space. And it'll be good for the space. It's kind of like those banks that, were allowed to go bankrupt in all the different banking crises over the last 100 years. We learned from that maybe if we regulate them earlier, they won't all go bankrupt. We won't have the same kind of leverage built into the system that right now is clearly happening.
What are what I guess their pushbacks though would be that the selling point is that there's no regulation, that there's free markets, and that is the basis of why it exists.
Yeah, but the free markets really, only seem to work for those who are insiders and understand them well. And then when things don't work out, everybody else is also left holding the bag. And,
Right.
part of having a society is having the kind of rules that protect most people. And, if you can show that you understand what you're doing, then it's okay to invest in things that are riskier. Or, if you regulate the intermediaries in such a way that people know that, they're not that risky, that, like your assets are protected. Let's say I buy Bitcoin and I hold it at Coinbase. Well, how do I know that if Coinbase goes bankrupt, it doesn't become a Lehman moment and suddenly I'm an unsecured creditor?
Yeah, which was interesting because in the recent 10Q that they filed, that was the new language that they added.
Exactly. So, which is why.
Talk about crying fire in a crowded theater.
I mean, it's made us think about, changing the way we do custody.
Right. Now, Jim, I know it's getting late, and I'll let you go. But I'm going to ask you one last question, and I don't know if how much you think about this, how much you'll be willing to talk about it. But I was wondering if you could put on your geopolitical hat. And I know that originally you had gone to Russia and you were involved with Russia in the markets when they first started floating a lot of those companies. And obviously, everyone is being interested in what's happened with Putin and this war in Ukraine over the last couple of months. Do you have any insights or anything that you'd want to share in terms of what you think is going through his mind, how you think it might play out, what the market might be missing?
I don't think the market's missing very much. I think, he miscalculated. I honestly think he made a mistake. Not that he's crazy or irrational. I think he miscalculated. We often miscalculate. We think the probabilities are one way and then they turn out the other way. So I think that he thought that if he invaded, it would be the same thing that happened with the Crimea. We put a couple of sanctions on him and nobody cared after August 2014. Kind of a couple of months worth of noise. And after that, the world accepted it. And I think, he basically, looking back at the history he had with the Western nations, he felt that the risk he was taking was very low. And, I think he underestimated what he had already won, because before the invasion, Russia was negotiating directly with France, directly with Germany, directly with the US. There was no Western bloc. It was interesting to me that countries were individually talking to Russia instead of as a Western bloc. And he obviously changed all that with the invasion. So now we suddenly have NATO expansion, where Sweden and Finland are probably going to join NATO. We have a Western world that's spending more on defense than they did before. I think it was just a miscalculation. And the problem I have is seeing an exit. I don't really see an easy exit for him. So I foresee kind of like a stalemated Cold War, kind of like Cyprus. Cyprus, Turkey invaded Cyprus. When was that? 1970s. And the island has been divided since. And I have a feeling that, Russia is going to dig in and just kind of keep people in the eastern areas of the Ukraine, and we will have sanctions on them. And over time, Europe will move away from Russian energy, and, it will make it more likely than not that Russia becomes a less important global player than it would have been if they had actually, kind of just stepped back and not invaded. I think he just made a mistake. And, I think
and so the market
is a frozen conflict.
Right. So although from a humanitarian point of view, it's obviously terrible, the market is quickly gone on to different things. And you think the market is correct in that this is just going to be a protracted affair with no real, with the chance of the West being dragged into it is low. And this is kind of the new reality of kind of the Russian versus the West environment.
Yeah, I think so. I think this could last for years. Unfortunately, I think it's a terrible situation, and we have enormous numbers of refugees that I don't know how they will go back to the Ukraine and want to rebuild, and it's a very difficult situation. But I think we're all just going to get accustomed to there being a frozen conflict, and Russia is going to unfortunately suffer dramatically for having miscalculated. And, their GDP is going to collapse, and people are leaving the country as quickly as they can. If the best we could do is probably encourage immigration and, create a reverse brain drain, have them leave and come here.
All right, Jim, we're getting towards the end. I just thought I'd leave you with one last question. And one of the things that I've experienced this, and I know a lot of other people have experienced when the markets go against them and they get into a situation where they're in a rut and they find all their positions going against them and they just kind of keep digging and making a mess. One of the greatest traders out there, one of the fellows that I admire, is George Soros. And George Soros used to go and fax his inventory to Goldman Sachs on a Friday afternoon. And he used to fax the whole inventory and then ask for a price. Goldman would price it all out and then give him one big price and then do all the trades. And he would flatten his positions and then start Monday fresh. And I've always thought to myself that this is a great way of dealing with the problems when you get into a rut. I was wondering, what do you do in terms of when you get into a rut? And more importantly, what do you think of George Soros's technique?
I think he's one of the greatest traders around. He really understands markets. I think his approach is driven, when you talk about the way he would unload his whole portfolio, by the fact that in those days, options markets were really not as available as they are today. And, I think the way I would replicate is by saying, I know precisely what my downside is virtually across my entire book. And, and if I'm really, really badly off, I know I will lose 20% and then I will basically be in cash, and that will be fine. So I think George did the right thing when he would clear the decks and start from scratch. I tend to do it a little bit more slowly by allowing the option premium just to go away.
I got it.
Also think that, George is a very special person. His approach was obviously incredibly competitive, did a brilliant job at trading, made a lot of money, but the most amazing thing was how willing he was to make the world a better place. I mean, how willing he was to make that money in order to give it away, to change the world, to a vision that he saw where democracy was more important. I mean, he brought democracy to Eastern Europe when other people were thinking that that was never going to happen. And, I just admire him for that. He just is an outstanding individual who was able to take a vision and realize it. And it's not all about his trading, it's about his view of making the world a better place and being willing to invest his money in that.
Well, that's a great way, a good uplifting way to end our conversation. And speaking of people that make the world a better place, Jim, thank you for taking the time. You are definitely one of those, and we always love having you on the show. And I know you're very giving and chat with people. If people did want to talk to you or get in touch with you, where would they find you?
Very easy. Send me an email, jleitner@falconmgt.com. I try to answer all of them. I'm sometimes a little slow, but I'll definitely try. And also, some people reach out to me on LinkedIn.
Okay, there you go. You're not only were you giving away your age, the fact that you started at Morgan Stanley in 1977, the fact that you use LinkedIn as your communication tool. Anyways, Jim, thank you so much. It's always a pleasure having you, and I really appreciate your time. Have a great week, and we'll hopefully catch you in another few months to get an update on all these great ideas.
Thank you, and thank you for having me.
All right, Patrick, it's time for Talking Charts. And we're recording this early. We're recording this on Friday morning before the markets open. So we have a chance to make real fools of ourselves even worse.
Oh, absolutely. We don't have a weekend buffer for seeing how foolish
That's
we are.
That's a good thing about producing the show on like a Saturday morning. By the time like Monday morning comes along, everyone's forgotten
what we call it. So for sure. Anyway, we are recording this Friday morning, so let's take a quick look at all of this. But first of all, a couple weeks ago when we did our last one, we were talking about whether it was a swing high for the U.S. dollar. We'll talk about that again in our top three because we have to.
Oh, of course, because you stuck it in the top three because I wasn't involved.
Because you weren't involved in it. Yep. That a couple weeks ago we had the FOMC, and they basically gave the market what they priced in, right?
Well, it was, if you remember back, that was the taking off of the 75 hike in terms of Powell nipped that in the bud, and we had that 4% rally that then got sold immediately after. So it wasn't quite exactly what everyone thought, but it definitely introduced a lot of volatility.
Yeah. And then we were asking what's next for the markets. Well, that's clear. They gave out that support, and we are heading lower. So let's talk about the top three things to watch this week. And I think the one thing that I really wanted to highlight was the high yield credit spreads finally started to crack. And we're seeing the widening of the of those credit spreads. Let me just quickly pull up on Koifin the credit spreads. So this is the high yield broad. And you can see this is a 3-year chart of the credit spreads. And while we spent much of 2021 and 22 in hovering in the low 3% range, we not only cleared 4% now, but it's on its way higher. And this is really important because, like, when we look at the charts, let's say of what's happening in Treasury, the 10-year Treasury notes, let's say, already bouncing, and you're getting a little bit of a reaction off the low as yields are back under 3%. You take a look at, let's say, the junk bond ETF, fresh lows, and it just continues to get hammered. So the question is that are the credit spreads telling us something? Are we heading toward that recession that everyone has feared? Is that what you take away from that?
Well, I don't know if we're heading necessarily for the recession, but we are having a kind of a tightening of financial conditions, which is what Powell and other members of the Federal Reserve wanted. He said it as much. In his press conference, he said that the way that their monetary policy works is through tightening of financial conditions, which affects the real economy. So therefore, he was in essence targeting lower stock prices, wider credit spreads, higher rates, all the above, and the higher dollar. And that was part of the reason that the market sold off so hard for the last couple of weeks, is that it's become very obvious that the Fed wanted tighter financial conditions. Now the real question is, have they started something they can't stop? And how tight is tight? Are they going to step back and try to jawbone it the other way? Now, before we continue there, we're going to prove once again that Patrick doesn't listen to the interviews. You can trade, by the way, thanks to Macro Alf. He highlighted the fact that you can trade the high yield ETF with just the credit portion. If you put HYGH on it, there's another ETF, and that represents a hedged out version of that. So why don't you pull up that chart and tell me what your tea leaves are reading there? HYGH. And the same with if you want just the investment grade one, you could do LQDH. So the H standing for the hedged. And so for those that want to play that pure credit portion and don't want the actual interest rate component, this is the way to do it. I think it's a great product. I'm a big thank you to Alf for finding that thing, because I had no idea that it existed, and it's nice to be able to have a product to watch that just shows you purely what credit spreads are trading. And as you say, Patrick, it's very clear with that chart that we're hitting new lows, and that it's definitely telling you something.
Well, that the financial conditions are tightening, and these corporations are finding it harder and harder to access credit cheap anyway. They have to pay up, right? And that's a byproduct of that tightening. All right, so number two, let's go with that dollar, buddy.
I'm surprised you didn't put it number one. That's all. Yeah. That's the only shocker to me.
Okay. Well, listen, number two or number one, the one thing that I thought was the big surprise was that it didn't even stall out along the decade highs. And we literally broke to now 2-decade highs. We have to go all the way back to where it traded here in October of 2002 in order to find levels that were essentially this high on the dollar. And the thing is so I want to kind of dissect that a little bit, right? So this was a breakout. Is it going to be a prairie dog? Well, I don't want to gooch it.
I was going to say, it to me it has all the makings of a prairie dog.
It could. And so I want to kind of talk about why I think that there's at least a reasonable probability that we have to consider or assign to it, right? So start off with the fact that, okay, well, let's go back to what drove the U.S. dollar rally in the first place, that U.S. dollar against the yen, and which was at a roaring rip. And this is already stalled. And so, you have to think that after putting on 2,000 pips to the upside in a span of a month and a half, it was going to, at some point, run out of momentum to the upside and actually backfill a little bit. But clearly, even though the U.S. dollar is broken out, it's the participation of the yen as the driver isn't there anymore.
I would agree. And I think what's interesting, Patrick, is that the yen and the bonds, which were both trading unusually correlated to the stock market, meaning that we had a situation where bonds were going down, stock market was going down, yen was going up, which wasn't really what you'd expect in terms of typically, the yen was going down, up in terms of that chart. That was a very unusual correlation period. And I think that what you saw this week, and Brent Donnelly, one of our previous guests, has been talking about this, how this correlation has returned to a more traditional and kind of environment. Yeah. And it will be interesting to continue to watch this. To me, it feels like the yen decline, the decline in the yen is over, and that you can buy it. And that's part of the reason that I'm thinking that we might prairie dog here, that this is as you say, the leader of the currencies that was going down the most has stopped going down and is actually rallying now. And so is it just a question of the U.S. dollar selling off versus those other things? So
where the big breakdown happened that caused the jump was the break down in the euro. So the euro was at a huge support along 105. So when you go down to the weekly charts, you can see when you go back to 2015, 16, 17, that the euro actually traded down to this kind of 105, 104 level. And what we're in a situation is where this actually hasn't broken yet to a new decade low, and that's like over a 50% weighting on a trade weighted basis in the Dixie. So just because the dollar index has broken to new highs, it's not really being yet confirmed by the euro.
And this is down a long way, and the bearishness of the euro is thick.
And so, like, what if we see a little bit of that turtle head poke down below on the euro below that previous low, just to wash out some stop losses down there?
Yeah, and that's an interesting choice of words.
And if you get that, and then that could offer a reaction. And if you see that the euro does not everyone now is clearly talking parity of the euro with this breakdown, but and maybe it does happen later this year, but it just seems too easy of a call to make. Like, this is a given. I think that there's plenty of room for the euro to surprise people with a little bit of a snapback, and that little breakdown that we saw here could be a fake out.
It's like Patrick, when you sit down at a bidet and you don't realize it's a bidet.
Woo, that's a surprise. All right. The pound sterling as well just been hammered. I mean, you have to go back to 2020 to these kind of levels where it consolidated. Obviously, the pound during the crisis had a drop much lower, but certainly incredibly oversold. The only place what I found really interesting is the breakdowns in the CAD and the Oz currencies. Right, the Canadian dollar broke the kind of 6-month lows, even though arguably it's not really been where the huge weakness has been. Here, I'm going to go to a weekly chart, but like the Canadian dollar, I mean, at this moment with the break, has a little bit of room to go, maybe 76, 75 cents. Even the Australian dollar could, make its way back to 66 to 68 cents on the downside. That could offer some little bit boost to the U.S. dollar index higher. But I think there's a lot of oversold conditions in the currency markets that could mean that this U.S. dollar prairie dogs.
Okay.
It's on the table. It's possible. It's on there. The other thing is it's interesting is that the incredibly oversold state of the asset that shall not be named. The fact is that it broke down these lows. And it actually did a little bit of, I'm going to use the turtle head term again. It just kind of poked below there, washed out all the stop losses sitting below there. And from a very oversold state, tried a 1-2 day little reversal. Now, that doesn't make me bullish, by the way. Yeah. It's simply that it was oversold and due for a bounce. It really feels like that we've seen a short-term point where we might see the reflexive snapback rallies ensue, and that's why I'll agree with you. It has a very good candidate for the U.S. dollar to being a prairie dog, but let's see if it happens.
Patrick, just before we get off the subject of the asset that shall not be named, I kind of note with a little bit of amusement that Mike Novogratz had a huge Luna tattoo, and for those who don't know, Luna is the stable coin or whatever it is, I don't know, and it had $20 billion of market cap 4 days ago. It has 0 now. I was wondering if your commitment seems to bonds and the U.S. dollar seems a little light these days. I'm thinking that you really need to get a bond tattoo or maybe a U.S. dollar tattoo, like a whole kind of shoulder sleeve kind of deal going on there.
Now, you know what? Listen, I am the number one bandwagon hopper. I have no commitments. As a trader, I trade the prevailing trends as they emerge, and I refuse to tattoo something permanently on my body.
You trade the prevailing trends, but you just hop on some bandwagons a little quicker than others.
Yeah, well, you know what? You have to be a flexible trader, and you have
All
to.
right, so we
you have to
can. So
recognize-
maybe we can get you a non-permanent one.
Yes, yes. We'll go to Inkbox, and we'll have them.
I think that's
custom
all a
make,
cop out that you just basically are too scared.
Scared. Well,
You are. Then get a Market Huddle tattoo.
That'll do. All right.
Okay, what do you got for number one?
No, number one is just obviously whether or not the stock markets may be putting in a short-term bottom. I mean, the sentiment could not be more negative at this moment. And the amount of people out there that are so sure that the market is going to hell in a handbasket, I'm not ready to call a bigger bottom, but in such an oversold state, typically those reflexive kind of snapback rallies do tend to come in and quickly get traders back in on the long side because they've all liquidated, and then obviously the Vanna squeezes and other things that can all emerge from here. And one of the things that I'm really curious about is whether or not this upcoming week we see that a short-term tradable low may emerge here in the markets. What's your thought on that?
Well, we had David Tepper covering his short. We had Bill Miller, even though he's a lunatic and only owns two assets in his portfolio, Bitcoin and Amazon. He's still a fellow that understands the markets. He said that there's a tradable low here. I think that some of the wiser traders that have been around, if they aren't calling for a bounce, they're at the very least understanding that the situation is, as you say, very, very stretched, and that the time to be pressing your shorts is probably behind you. Yeah. The time to do that was when people were still looking for a bounce, were buying, all the ARC names and thinking that we were going to rally and telling us how we were going to go back up to highs. I look at your other doom porn channel there that you go and cheat on me with, and I see a very bearish post this weekend, and it just seems to be that is the prevailing sentiment, and those are the kind of things that you see closer to the lows.
Closer to the lows. At Big Picture Trading, we monetized and adjusted a lot of our hedges on the SPY and the IWM. We took all of the profits on the hedges and adjusted. It's not that it guarantees a market going up, but I completely agree. This is a market that can surprise people with a bounce just and on even no news. It could just emerge, and suddenly the market's ripping.
A lack of selling is all we need, Patrick. That's all we need, because things are being pressed so far to the downside. All we need is just the selling to light up, and everyone's going to be, holy smokes, the next offering is 5% higher in terms of size offerings.
Yeah. Now, the one thing I want to make sure our listeners are clear, like the macro conditions are there still for tight markets. And so therefore, I'm not looking for an extraordinary new bull market to emerge off of a short-term low, simply that the selling that has been almost relentless for the last month is going to subside, and we're going to see markets potentially calm down and mean revert a bit for maybe the rest of May.
Yeah, well, and if they don't, Patrick, I've said this for a while, that one of my big concerns out there is that we don't understand the amount of credit that was created in the crypto community.
Yeah.
And you see with this Luna, this collapse overnight, and if we get something else from there, one of the things that we have to be always cognizant of in the back of our minds is that when you enter into the liquidation phase, it's difficult to guess when it'll end. It'll end when it ends, and it'll end when the weak hands get shaken out. How many weak hands are there? Who knows? I don't know. But if it continues, I suspect that it'll be because there's more fundamental problems on that side than we think. Right. But assuming that there's not, and assuming we can get that market to stabilize, because I do think that market has been what's pushing this. I just think we, as you say, the selling will subside and we will get a bounce. But I'm the same way as you, Patrick. It's tough to get excited about it. It's tough to get excited about these stocks. I still think, I wrote about it last night, I think that these tech dream stocks are going into a nuclear winter. I think that when you wake up a year from now, the Nasdaq's going to be lower. A lot of these big, even the FANG mats, I think they're still going to be for sale. The question is this the point to be pushing your bets when everyone else is and when it becomes very obvious? And I think you and I as traders both recognize that as we're down 28% or whatever on the NASDAQ, that, could it go lower? Could this be the big crash? Could we be making fools of ourselves right in front of an 87 type decline? Sure, but that's not the best bet right here.
Yeah, you got to go with probabilities, not outliers.
Yeah.
Or at least if you're going to, at this moment, if you're betting on that crash, you might as well just spend the money on the left tail and buy some left tail gamma and then just cover your actual shorts, because at this stage it's foolish to give up the profits if you've been short. Anyway, what I want to talk about is the commodities. Now, it's been bloody. It's been bloody, whether it's been uranium getting killed. I know that you've been toying with it down here, whether it's copper getting shellacked all the way down to its year lows, whether it's gold and silver, like silver broke its 2021 lows.
Can you pull up the silver chart? Because I want to prove something again.
It's right here.
You know me, not much of a technician. Don't practice the dark arts.
No such thing as triple bottoms.
That's the only thing I believe in. I have one technical rule. No such thing as triple, quadruple, whatever you want to do bottoms. And silver proves it once again. Okay. Actually, that's not true. I have two technical rules. No such thing as triple, quadruple bottoms, and no such thing as a bad tick.
There you go. All right. So you heard it here from Kevin. All right. So, but the one thing that I wanted to kind of highlight, that while the commodity markets have had their faces ripped off, the one area that held up like a champ is oil. Oh, yeah. And every dip is being bought, higher highs along the way. And I asked the question, well, right now it feels like oil is just being repressed because it's a risk-off cycle. Nobody wants to go and chase risk at this moment. And so oil is just kind of taking a break and waiting it out. Well,
and not only that, Patrick, it's also denominated in dollars, and the dollar's screaming higher.
Exactly.
Yeah.
And so the question that I'm curious about, well, what if the dollar does prairie dog, and what if suddenly risk assets are back temporarily while we're bouncing off of incredibly oversold levels? The thought I have here: does crude oil lead everything out on the upside, like as in the kind of bull leadership of another leg higher, where if when people are going risk on, do they chase oil as oil goes ripping to a fresh high?
I hadn't actually thought about that. I've always said that copper and gold are going to lead our way out, but maybe you're right, because on a relative basis, oil is the one that's exhibiting the strength. Our friend Cuppy there, he talks to me. I talk to him on a regular basis, and he said, can you imagine where oil would be if the dollar wasn't doing this and if the market wasn't pricing in a recession? And I was like, yeah, you know what? He's right. Yesterday, I actually dipped my toe back in. I had been no longer as long as I had been, and kind of had reduced a lot of my oil energy kind of company names. And I started buying them again, Patrick. I just couldn't wait it out anymore. And I kind of thought the same thing as you, that if this is the worst, if we've experienced the decline in all the commodities and the correction in the stock market, and this is as good as we're going to get, then maybe that it is the one that leads. And I had never thought about that way. So thanks for that, and hopefully I don't Gucci it by going and adding to your trade.
Well, you know what? Listen, these are the things we're just simply asking. It's the things we're watching, and if they come to fruition, you just have to act upon them, right?
Yeah.
And those are anyway the things that are on my mind. All right, I think that's enough. We have to keep this one a little bit shorter today. So that's what I got here, Kev, and we got no other segments.
All right. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at themarkethuddle.com or whatever it is. Give Lena a shout out. She's tired of talking to Patrick and I. You guys know where you can find us and all that thing. So Patrick, where can they find you in terms of you and your great product? Where you can find out about monetizing hedges down here.
There you go. You can do it at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. And Kev, where can they find your spectacular newsletter?
This is like a mutual adoration society. I'm on Twitter at Kevin Muir, or you can check me out, my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now, stick around. I guess, should we have a little bit of an after show?
A little bit.
Okay, let's have a little bit of it. Lena.
Hop on. Lena's still out in Barcelona.
I know,
You
guys
blamed
are-
me. You blamed me for actually why we're recording early, but it's Lena. We didn't want to leave her till 3 in the morning out in Barcelona.
It's actually funny because no matter what happens, it's always Patrick's fault, and I never blame Lena because Lena's in
That's
charge.
the right-
Not only that, Lena is a nicer, better person than both Patrick and myself. But not only the more important thing than that, she's in charge of the editing, so she
Yes.
can make you look good or bad depending on what she feels about you. So you
better fix that.
The
Start
number
there,
one
I think.
rule is you never ever make fun of the editor.
Yes, you don't.
It's
do
like
that.
those guys on, you know how sometimes they leave the mic hot and you see them. So she can do that to you. So you never ever.
It's
right.
you gotta be careful. So
I
Kev,
have a lot of dirt on both of you.
That's
yeah,
right.
there you go. Kev, so Lena and I were out in Barcelona drinking, and we were doing street beers, and we actually said, well, you know what, we got to bring this back, and so Lena's got a beer for you, and we're going to be drinking some Spanish beer.
Some Spanish street beer.
I'm not going to mention any names or anything, but we're
We'll
going
tell
to
you the
feature.
full story when we drink it. Yeah.
Okay, well, I'm
Exactly.
looking forward to it. It's I always like street beer.
Yeah,
It's like street meat, like street, hot dogs or
Street
whatever.
beer.
It's like street
It's a-
beers.
yeah, no, it was good.
Are you guys having a good
Yeah,
time out there?
Well, I'm back in Lisbon.
You're just
and-
traveling around the world.
Yeah, and I'm gonna head back to Toronto, bud.
Yeah, for
Yeah,
what? Like a
for
weekend?
a piss up.
For a
No,
weekend?
piss up.
For a piss up. It actually should be good. The piss up. I hope everyone can make it. Please come on out and say hello, even if it's just for an hour after the market closes before you head home to your family. We'd love to see you. It's going to be a lot of fun. It's a big venue. It should get 150 people outside. So we're hoping that we get that kind of number. And we're hoping we get through our 50 pitchers because we got to drink them. We have to settle them
You
up.
guys can't afford new livers right now, so
Yeah. We have to
we're
drink
gonna
them.
Come and help.
We were actually looking, for those who are interested, we were looking at some fancier kind of douchey kind of Bay Street places. And then we basically decided that that's not really us. And that the sports bar kind of place, they seem much nicer and much more interested in our business. So we were like, okay, let's go with these guys. And it's beside the Hockey Hall of Fame. For those who are traveling in, make sure you go and do our one big Canadian, Toronto attraction. Don't you think that's the number one attraction? Well, I guess that's the CN Tower.
CN Tower.
I don't know, though. A lot of people come for the Hockey Hall of Fame. Like, I know a lot of people that I've met that come from, they come up to Toronto with their kids or whatever, and they're like, oh, yeah, I came because of the Hockey Hall of Fame.
Oh.
So
Oh.
go.
Yeah, I had no
Yeah.
idea.
You've never been to the Hockey Hall of Fame?
I have.
No, I have, but I didn't know it was like a.
Oh, yeah, no, it. Oh, for sure. No,
Well, I think what it is that from all over North America, teams come to play in hockey tournaments in Toronto, and part of that is the team goes to Hockey Hall of Fame as a part of it. It's a very natural thing to do.
Yeah, I guess that's true. Speaking of hockey, for those who are interested, Patrick is in Lisbon. He told me this morning. So we're taping this at 6 a.m. my time, like Eastern time.
Eastern time.
Yeah.
And Patrick says, "Well, thank God I didn't stay up to watch the Leafs last night, and I was trying to figure out what that would be on his time schedule." So, Patrick, you were actually
like
considering
I said,
it.
I stayed right up until, and then I just passed out. It was like 12:30 at night. I'm
6
like,
beers into it. I was like, "Oh, it's 3 a.m." So what time? What time is the game going to start? So those who don't know, the Leafs are going to the 7th game. Patrick has now told us that he is staying up to watch it Saturday night.
because it's Saturday. Yeah.
And so what time is that going to start in Lisbon?
12:30.
It's going to start at 12:30.
So yeah, I'm London time.
Okay, this is what I'm hoping. I'm hoping the Leafs win, but I'm hoping it's like one of those epic 4 extra
Overtime thing, so that I'm
periods.
pulling all nighter.
So it's like 8 a.m. by the time Patrick finally That's what I'm hoping.
Thank you. It's very kind of you. Me personally, I'm hoping the Leafs score 3-4 goals, and then I go to bed. That's like
but so it is the Leafs. So they scored 3-4 goals that they're gonna lose.
But you know what? I would prefer to go to sleep thinking they won, and then find out in the morning that they lost.
It's
right?
kind of it's kind of like when you put a big position on, and then you go look at and overnight, like you go to bed and it's still everything's way up, and then you get up in the morning, you're like, what the hell happened? This booze was up 30 when I went to bed, and now it's down 40, and you're like, oh shit. So that's basically what you're gonna get. You're gonna get spoozed on the Leafs.
That's exactly what's gonna
Okay,
happen.
well, we'll let everyone go.
All right.
Have a great day. Thanks for tuning in, everyone. And June 1st at the Bottom Line, 22 Front Street. We hope. Yeah, mark your calendars. No cost. Just come help us drink some beer. We'd love to see you there. Thanks for tuning in. Have a great week, everyone.
All right, take care.